My name is Zhou, Senior Investment Analyst in Mirae Asset. Since the housing privatization reform in the late 1990s, China has given local governments land revenue sales to fuel urbanization and infrastructure investments. However, this has caused local governments to over-rely on land as a financial accelerator. Over the past decade, land and property-related revenue account for more than 40% of local government revenue. Meanwhile, local government financing vehicles will put up land as collateral to obtain bank loans, which has become a growing concern for the local government's implicit debt burden. Large stimulus in 2015, such as Shantytown Development Program, strengthened expectation that the housing market can only rise. This led to speculative demand and excessive risk-taking among developers, especially in low-tier cities where local governments only focus near-term GDP growth targets. The high leverage and high turnover pre-sales model adopted by those aggressive private developers accelerated this vicious cycle, resulting in dangerously high leverage. On the other hand, mortgage, which is the largest component of household debt, has increased significantly in recent years, with the proportion of household debt to disposable income rising sharply to over 100% by 2021. Recent results of the 7th demographic census show that China has slid into the age of low fertility, indicating that the Chinese population is near a peak. This means that the key cohort of home buyers has been declining. Therefore, long-term demand for housing, after considering demographics, urbanization, and household formation, is expected to decline 25 to 35% in the coming decade, especially after the speculative push in the past 4 years. With the fast development of tertiary industries, metropolitanization attracts more population flow to high-tier cities. This trend will exacerbate the housing inventory bubbles in overexpanded low-tier cities. In August 2020, after the initial COVID outbreak stabilized, the People's Bank of China met with the Ministry of Housing and Urban-Rural Development and China's 12 largest property developers to implement the 3 red lines to curb debt buildup among developers. This marked the beginning of a painful downturn in China's housing market. Developers' liquidity, especially those of highly geared private developers, tightened significantly, resulting in a slowdown in property investments. Strong housing sales, especially in high-tier cities, started to soften after tightening mortgage quotas in early 2021. Initially, the government was more patient as it has already built many firewalls for the financial industry and has diffused many systematic financial risks in the past years, especially in the shadow banking industry. However, the resurgence of Omicron led to lockdowns and restrictions on economic activities, which not only hit the property market hard, but also dampened overall economic growth and confidence. By summer 2022, China's property sales volume, new starts, and property investment have all declined significantly from previous peak. Without a pivotal policy response, the ongoing zero-COVID restrictions impact and slowdown on the economy could create a negative feedback loop between the weakening macro backdrop and China's housing market. And further weakness in housing sales will cause more disrupted deleveraging, even among high-quality developers. We agree with policymakers that the property market and the land-centric fiscal model have reached an inflection point. However, in the near term, especially in the various COVID restrictions, without policy adjustment, a continuous slowdown in the property sector will bring unintended consequence and threaten macro stability. Since third quarter, we started to see a more decisive and holistic policy approach from policymakers, such as recent 16 measures from PBOC and the CBIRC. The policy stance has clearly shifted from targeting project completion only to also supporting property developers, both SOEs and high-quality private developers. This can boost market confidence and stop the vicious cycle and buy times for market recovery. We think this is a more practical way to facilitate a soft landing with a smaller price tag. But ultimately, we believe relaxing zero-COVID policy is the most crucial policy to unleash China's economic growth and address the key demand side of the issue. Thanks for watching.